Amplats released full-year results today. The first half of the year characterized by the unprecedented 5-month strike in the industry, while the second half showed a faster-than-expected ramp-up in terms of production, in part seeing the miner back in the black, so sitting at profitability. And joining us right now is the company's CEO, Chris Griffith. Thanks so much, Chris, for your time today. Having said all of that, earnings still down 46%. As you count the cost of last year's 5-month strike, where are your confidence levels sitting right now, not only as far as having things back on track are concerned, but as far as labour not being more of a disruptive force moving forward is concerned?
I think we spent quite a bit of time in our results today actually trying to give the market and our shareholders also, some comfort that the fact that we were very well placed, having the ramp up and then also our final quarter's production meant that we've got labour stability, we've got production stability, we have we get the labour stability from the 3-year agreement that we have in place, and I think we're well placed for production for 2015. The market fundamentals, I think, are also in a very good position, and so as a combination of all of those, I think we're well placed for this year.
How are you rating morale amongst the labour force?
Yeah, I think it's demonstrated by the ramp up. So we were anticipating about a 3-month ramp up. After 2 months, we were already at full production. And in our final quarter of the year, we were 12% up on the final quarter of 2013. And that comes from a management team and an employee team that are really working together. And you can see it and feel it when you go to the mines. The morale's good, the management teams are confident, and the relationship between management and the unions is at really good levels. And I haven't seen this kind of level of management union relationships for many years now.
Still, having had the experience, it's made you very cognizant of the reality and the shifting landscape as far as the labour environment in South Africa is concerned. How's that influencing your business strategy, if at all, with the majority of your assets in South Africa?
I don't know that it's we've been in South Africa for many years, and I think the real turning point was actually the Marikana tragedy rather than this year's strike. We saw the emergence of AMCU. AMCU were recognised. They'd made all these promises since 2012, and it was with that we had anticipated this was going to be a very difficult labour relations year. But we've seen strikes in the industry before. We've got our assets in South Africa. We've been on a modernisation drive in our mining company for a number of years now. So it's not as a result of Marikana or as a result of the strikes. I think those have just highlighted the need for us to speed up the process of our modernisation, focus on mechanisation, but also the modernisation of our labour relations environment. We've had a program in the company for more than 2 years now around a cultural transformation. I think that's also part of the modernisation of the company.
It also forces you, or has forced you, to be a little bit or exercise more scrutiny when it comes to the stable of assets that you hold. And you've announced that you're looking to sell your Rustenburg assets, Union Mine as well. Have any viable opportunities emerged on that front? Because those have been on the block for a year. So the question is, what's the hold-up?
So no, they haven't been on the block for a year. We announced the restructuring at the beginning of 2013. That restructuring process was about consolidating the mines, taking out loss-making production, and I think that needed to be done first before we could focus on the repositioning of our asset portfolio. We announced only at the half-year results in last year that we were going to be exiting the mines of Union, Rustenburg, and 2 of our JVs. Now, clearly, we've had the planning for that process, optimizing the mines, developing optimal mine plans, and now what we've seen at the end of the year, we've now entered into a shortlist. We've got a shortlist of companies, and that shortlist of companies are now doing due diligence on both Rustenburg and Union. We always said that we'd do well to get these assets away in 2015, and our program is well aligned to that.
Where you're having to contend with rising costs, subdued prices, and loss-making operations, to what extent is that leaving you compromised on the price-setting side of things for those assets?
Look, the price will be a function of how good our mine plan is, how well we're executing to our mine plan, and what our costs are, and what we anticipate the prices for our metal will be. So it'll be a function of all of those, and that'll determine a value. And then there'll be, do certain parties have the ability to actually pay for those assets?
Yeah. You alluded to mechanization or modernization of your mines. That leaves, what, half your workforce sitting vulnerable right now. How's that plan being digested by government, by Labour? Because one assumes that, it is a hard thing to swallow in the current environment.
Look, this doesn't just mean that because you mechanize that all those other people lose their jobs. The fact is that we've been on a mechanization or a modernization drive for a number of years. We've got the Batupele mine, we've got the Unki mine, and two of our JVs of Mototolo and Kroondal have already been mechanized mines. What we're seeing is, as per mechanization since the Industrial Revolution, what you see is if you lose labor in the direct jobs, you pick it up in the more service-related jobs. That's exactly what we're seeing. We're picking up more jobs in the suppliers. We're picking up more jobs in the maintenance of fleet and equipment. So I think that's part of the overall mechanization, to say, yes, the fleet, the people working on the face are much safer, much more productive, but we're picking up jobs and creating jobs in new areas.
Yeah, you've had cash generated from operations up 8%. It's sitting at 7.9 billion, and it funded or helped fund that 6.9 billion rand capex. So what's your capital expenditure plan looking like moving forward now into 2015?
So we gave guidance today between 5.5 and 6.5 billion. That's as a result of we've been able to be more efficient with our stay-in-business capital, but at the same time we've got some unapproved capital there, probably about R1 billion, that it'll depend on the time frame for approval of those projects, but between 5.5 and 6.5 billion.
And where exactly is that being directed?
Well, currently about half of that is on stay-in-business capital. We have a number of projects that are ongoing that are getting capital spent at Twickenham, at Mogalakwena, and at Amandelbult, at Tumela. But the big projects, the unapproved projects that we're working on, is the redesign of Twickenham, the life extensions at Amandelbult, and the debottlenecking of Mogalakwena.
I ask the question because in your results you speak of improving fundamentals. Local issues aside, I mean, global growth and the recovery there has been slower than anticipated, because despite the disruption we've seen on the supply front, prices have remained weak. Does this leave profitability of platinum mines at risk? To what extent in your books?
I've been speaking for a number of years now, well, for the last 1.5 to 2 years, saying that the fundamentals of the PGMs, the platinum group metals, are getting better each year. For a number of years, the platinum producers were oversupplying the market. There was this big overhang of oversupply. In the last couple of years, that's been worked through now. And we believe that with the sell-offs that we saw last year, that there's actually very little material. So the above ground stocks have reduced from about 4.1 to 2.5 million ounces. So the liquidity of the stock and of the above ground stock is much reduced compared to what it was a couple of years ago. And at the same time, we're seeing demand is increasing. Demand's increasing in investment, it's increasing in auto catalysts, and it's increasing in industrial uses as well as jewelry. So all round, I think the benefit of the increased demand, although the world economy doesn't look like overall it's growing, in the areas that we supply platinum to, those areas have increased demand. Because of the increase in demand, lower above ground stocks means, and the shortages of supply, means that the fundamentals are still in a good space for platinum.
Very quickly, Chris, what's your message at Mining Indaba 2015?
I think the platinum industry is well poised for 2015 to have a much better year, to put behind us the difficult years of 2014 and 2012. The fundamentals for our industry are improving by the day. The global economic factors that are depressing prices at the moment aren't going to be around forever. And I think we're well placed. Our stocks are well placed. South Africa's got some challenges, but we're working through those. And I think that there's a positive message for Mining Indaba 2015, notwithstanding things like Eskom and mining charter reviews. Those are part of life. We're working through those. We're not affected to any material extent yet by Eskom. So I think we can manage through those. We can manage through this difficult period. Although it feels really tough, given where we've come from last year, I think we're well placed for 2015.
Well, let's leave it there. On that note, Chris, thanks so much for your time today. Of course, Chris Griffith is CEO of Anglo American Platinum.
Great.
Perfect.
Thank you very much.
Thank
I'll
you
try not
very
to walk
much.
away with this.